budget is not just, oh, let's just write numbers. No, it goes through phases and it's tested and it's based on facts and numbers. The idea of a budget is to align you, like it creates a roadmap. Whenever you are derailing or whenever you are out of track or underperforming or outperforming, you will know. Hello everyone. For those of you that this is your first time, I would like to say welcome. My name is Bibi Ofiri. I teach people how to become financially free with multifamily. Multifamily, it's one of the pathways for you to create wealth, but the thing is, it's not that straightforward. There are processes to it, and if you don't follow it, then you might have an issue with it. So today we'll be starting up with the topic. We'll be talking about budgets briefly. I'll be sharing a sample of what exactly I'm talking about, and not just that, we're going to go through them a little. It's going to be very fast because we really don't have time, but I believe that by the end of today's conversation, some of us will be equipped enough for our own personal deals, or you have the knowledge for you too. So what exactly is a budget? A budget is just a roadmap. It gives you an idea of what to expect in terms of income, gives you an idea of what to expect in terms of your operations, and gives you an idea of what to expect in your CapEx and every other aspect of your deal. If you are new in the multifamily space, you might not understand what this really means. It's very, very important because, like I always tell people, multifamily is like every other business that has the profit and loss, that is income and expenses. That is how it is. Since we all know that if we can control each of those areas, we'll be able to put our property back on track. Now, since we know that budget is a roadmap, when do you think you should create a budget? A budget is created at the beginning, right before you take over or you buy the property. And a budget, you must have the knowledge for you to say you want to create a budget. That is, you must understand the local market. You must understand the property itself. You must understand how other properties in that particular market are performing, because sometimes the market affects the property in the sense that if the market average occupancy is 90% and everybody's doing things correctly, it means that you will still fall under that range, between 90 to 91%. But if the market is at 95% and the property you're buying is at 90%, it just tells you that you have a wiggle room to increase your property to an additional 5% because your other competitors are doing way above you. So that is the reason why you need a local property manager that will give you an idea of how other properties are performing. Why am I saying that you need to involve a property manager at that time or at the beginning? It's because unlike you might have one or two properties in that market. A good local property manager will have multiple properties and they understand the market because really they do research, they operate these properties. It's their full day job. For you, it's not your full day job. Some of you have W2, so you might not have that time to do as much study as they should. You might not have that time to go out there to find out what exactly is happening. So you get to involve them and they give you an indication of what the income should look like, what the expenses should look like, and what likely are the CapEx should look like. And when they're giving you that can be used to create a budget at the beginning. So what we normally do is we create our budget based on our business plan. So I get a property, I want to buy it. I first of all do the preliminary underwriting. I go visit the property. I ask questions. I come back. I firm up on my underwriting. I send out an LOI. The LOI gets accepted. I go again and check the property right before I sign my PSA. I do all those things to verify, not to waste anybody's time on whether the deal is good or not. And again, for me not to spend a lot of money going through the due diligence stage and not having to get my money back. I signed the PSA. For those of you that don't understand what PSA is just a purchase agreement. So I signed the PSA. After I signed the PSA, we go through the due diligence. But all these processes I've mentioned, I start working with my property manager as soon as I've gone to do my first store and I've gone to check my numbers after doing that first store to see whether it's a green. The moment I know it's a green, I involve my property property manager and say, this thing looks good. I want to know what you think about it. They give me their indication. I compare with mine. We have some conversations. We do some back and forth. It's possible that I have more knowledge than they do because I've visited the property, I've asked questions, I've gone around, I've asked some questions. So we go back and forth and we challenge the status quo. Then we firm up on it. It does not end there. Towards the end of the deal, we keep the indication, definitely now become the budget. We'll go through some phases because as soon as you sign the PSA, you get access to more information because that is when the seller is mandated to give you a lot of documents for your due diligence, because it's possible that they have lied right before you signed the PSA. But because you now have access to the financials, you can now maybe detect the lie and go back and redo your indication. Your property manager will go back and say, oh, wait a minute, we thought this, but based on what we see now, that's not the case. It has happened to us over and over again. We get to see things that we say, oh, we didn't see this at the beginning. Oh, our indication is not correct. This is what is likely to be based on the information we got. All these things that we are doing builds up our budget. So budget is not just, oh, let's just write numbers. No, it goes through phases and it's tested and it's based on facts and numbers. So towards the end, we now firm up on, because we finished all, because our due diligence does not stop in 30 days. It continues till we close. Like a week before we close, we now firm up on our budget. They send it to me for approval. I go through it. Sometimes I don't agree with some things. We talk about it. They tell me their reason. Either I say yes or no. I tell them no, we need to do this. I don't think that's the truth based on what I see, because they are doing their due diligence. We also as a team are doing our own. We come to a conclusion. I approve that budget and we start to use it. That is how a budget is formed. I needed to go through this so that some of you would understand how this is done. Now you've created the budget. The idea of a budget is to align you, like it creates a roadmap. Whenever you are derailing or whenever you are out of track or underperforming or outperforming, you will know. What we typically do is we compare every data of today. There's a difference between projections and what you are doing right now. We take that data of today, and what are those data we take and compare with the budget we've created. First of all, let me tell you the component of the budget in this case. The budget will have income. The budget is divided into the income part. The budget will also have the expenses part. The budget will also take cognizance of your CapEx. What are the renovations you want to do? And the last thing, your net income. Is that net income you're able to realize or know what kind of returns is going to give to you and all that? You would know right ahead. And when those things are not happening, you trigger something if you are paying attention. So the same way your budget is, that's the same way the reality is. So for example, for your income, if you run a multifamily business, for those of you that are new to multifamily, we get income from tenants. That is what brings about our income. But remember, the income has different buckets. The first bucket of the income is the gross potential income. What that means is that what is the market doing? Literally, that's what it is. What is the market rate of income? So it's possible that you are at 1,000 and the market is at 1,200. So the 1,200 is the gross potential. That means it's a potential. That is, there's a potential for you to make that money. That's the first bucket. The second bucket is, will there be vacancies? Are we saying that throughout 1 year, every day, every month, nobody will leave our property? People will just sit down and nobody will say they want to leave. Nothing will happen. No one will die. No one will say they are relocating. No one will say they've changed jobs. It's not possible. Something must happen. At least 1 or 2 people, sometimes 5, 7 people leave a property every month. So you put vacancy in another bucket. The next thing again that is under income is the loss to lease or the gain to lease. So like I said from the beginning, if the gross potential, which is the market rate, is 1,200, it means that you are losing 200 if you are collecting $1,000 from tenants. That 200 you are losing is called loss to lease. So that 200 is another bucket. That is what they call loss to lease. If you are gaining it, that is the market is at 1,200 and from 1,000 you were able to move your rent to 1,200, is a gain. That means you've gained 200. So that's why they call it loss/gain to lease. It's possible you are losing, it's possible you are gaining. The other bucket is concession. Some properties don't do concessions and some properties do concessions. So it depends on you if you are doing concession to attract people. And the fourth bucket is delinquencies and losses. Your delinquencies, you must take account of them. Bad debts, there are some rent you can never recover, never ever. That one is taken on that thing. So those are the different and we have other income, things that you might have done or you want to do that can improve your rent. That is, apart from the rent people are paying, you want them to pay you for parking, you want them to pay you for taking out their trash, you want them to pay you for pest control. Those things fall under other income. Those are the buckets set around income. So income is not just income, it has different factors. And once you're able to do that, the end of it is called gross income. So that's what you have as your income at that point. You also have the same thing as your expenses. So there are two different types of expenses. We have the operational expenses and we have the CapEx expenses. They are two different things. How do we differentiate them? Because sometimes we've seen people putting CapEx expenses under operational expenses. So what are their differences? Operational expenses are things that occur, it's ongoing, every day it's happening. You are running adverts every day because you've paid maybe a 1-month subscription every day. Your advert is on Zillow, your advert is on apartment.com, it's an everyday cost. You have a website you've paid for a month, those things are everyday cost. Your utility bill at the end of the month, they send you a bill, it's a monthly cost. Those are called operational costs, things that accrue on a daily basis, things that are active. Most times they have a short-term lifespan. So those are things we regard as operating expenses. Compared to CapEx, CapEx are things that look like a one-off. They are not recurring. It can happen once in the time you're buying that property. You don't change roof every time, or do you? You don't do your CapEx every time, or do you? There's so many things that you don't do every time. So those things fall under things that have a large number of lifespan and they don't occur every time. So that's what it is. Please, if you have questions, please put it there. So we're going to share a template of what that really looks like, and we are going to compare it with the budget for you to know, to see how the two of them move hand in hand. So I'm happy I've been able to explain to you what are the different aspects of a budget and how that applies to your actual income. Richard, you have a question. While they are trying to share that, let me read your question, then we can go through the chat. Under CapEx, given the increasing focus on sustainability, what's the financial case for investing in green CapEx projects, solar panels, high efficiency insulation versus conventional, less expensive alternatives, and how do you quantify the long-term return on investment ROI? Let me answer the first half of it. CapEx is done based on the return. So like I always tell people, not all properties are the same. Yes, the solar panel, high efficiency insulations, those things are good, but you need to check what type of returns that will give to your property or what it will not give. So for a property that maybe the tenants are paying the electricity, it's not the owner paying it, will I want to invest in solar panel versus investing in maybe renovating the units to keep the tenant? If I was asked to pick any, just because the tenants are the ones paying the bill, it does not come to me directly, I might not prioritize that. I would consider renovating that unit versus doing a solar energy at that time, because that will give me returns, because it might make the tenants stay longer. If I do a solar system, it might not necessarily transform to a return on investment. So CapEx is based on what kind of returns that will give to you, and it's not a one size fits all. What is applicable to building A might not work for building B. Yes, we need to follow the trend, but is that trend going to translate to ROI? Because anything you are doing should translate to return on investment, period. So I have a property that we have a chiller system on it, and we're discussing whether we should convert it to individual HVAC system. We looked at the cost and we looked at our tenant profile, and we're like, it's not going to mean anything to them. It's not going to make them stay or not to stay. We'll just end up spending more than $1 million, and it's not going to improve on our tenant retention. And besides, what is not broken, you don't fix. Those chillers are almost brand new. Why do we want to change it? Compared to if we're in a neighborhood, and in that neighborhood, there are new builds there, everyone wants something new and all that. And maybe the right way to attract people to your property is for you to improve on your amenities. That might be a reason why I would do it, because I know it's going to bring me more better tenants. So you need to justify what you are doing, your CapEx, based on the return on investment. Remember the keyword, return on investment. That is what will determine if you should do your solar system, high efficiency insulation. That's it. The other second half is under OpEx. What's the most effective way to analyze and benchmark a property's OpEx against market average to identify hidden inefficiencies? And how do you implement cost-saving measures without compromising tenant satisfaction? All these things are done at the beginning. That is what we are discussing today. That is what your budget should address. Your budget should be the most effective way to benchmark your property's operation. That is what it is. And you put your budget alongside with KPI. Last week we discussed KPI. If you are not around, I will advise that you go watch it. The budget is the one that will help you benchmark to know when things are off track. Your budget is going to take cognizance of the market average. It help you identify your inefficiencies, because while you're putting it side by side with the actual, what currently is happening, you would identify that there's a problem somewhere. So I'm going to show you a template of what that looks like and how my budget will be able to help me identify that something has gone out of track. Thank you, Richard, for your question. This is what I was talking about. So on my C column, there's a C column. It has the actual. On my D column, it has the budget. The budget was created at the beginning, and we review our budget twice a year or every year, depending on when things are going off track. It's possible that we underestimated our income. That is, we might have under budgeted. It's possible. Or the market just changed drastically, or something just happened and there was a turnaround in the market. At that point, with the property management and the team, we go back and we will now redo another budget that will help us address today's issue. So budget is reviewed every time. Most times I review budget twice a year or at least once a year. And why we do it once a year is because every year we're trying to look back at what went wrong in the previous year, and we're going to incorporate it with the next year. So the budget you had at the beginning might become absolute after a period of time. So you need to constantly go and reiterate it for it to be sure to measure what it's supposed to measure. Okay, so in my C column, you see the budget. So this budget was created at the beginning of a period. So you can see now my gross potential rent. You can see there's a difference between the two. There's one that is saying 231 and my budget is saying 204. It means that the market has exceeded my budget. That's a good thing. That means the market is overperforming. Fantastic. So it tells me that I have more opportunities that I did not account for, right? The other one is going to lease. Okay, saying the opportunities, being able to get 65,000 of those market rent that I didn't get before. I've taken 65 of them, but my budget says the opportunity I would have had was 6,000. You can see there's a large discrepancy. So my budget is telling me that I am overperforming at this point. That's what it's telling me. Then loss to lease. My loss to lease is showing me that I still have a lot to catch up with the market. $90,000. I've not caught up with it. That means my rents are still way below what the market is collecting. And my budget was telling me initially that I only had $4,000 to collect. You can see that both of them are different. So when I come to the net effective rent, you see that they are almost alike. Yes, my effective rent, both of them are almost alike. So long and short of it is that in terms of my net effective rent, we are not far apart. So this can really fly. That means my budget is telling me that I am right on track. So my vacancies, my budget set 14,000. In reality is 19,000. It tells me that I need to double up on my vacancies. I need to watch out for my occupancy. My occupancy needs to meet up with what my budget is saying, or I need to get it up to 14,000 or below 14,000. So overall, my net rental income, it tells me that my net rental income in my budget was 93,000 and my actual, what I really got was 88. It means that I am falling behind by approximately $5,000 on this deal. That's what it tells me. And I can really see that those things came out from maybe my vacancies and some other aspects. I can see if I'm on track or not. That's it. Then my gas and electric, there's nothing here because this property does not collect reimbursement. And my water and sewage reimbursement, my budget said I should be collecting 5,000, but I'm collecting 1,005. When I see stuff like this, I go to the property manager and ask questions. Why are we below the budget? Either they tell me that, oh, we still have some vacancies, more tenants have not come in for us to start getting more reimbursement from them, or some of the leases they've not renewed for us to incorporate reimbursement to them. So there's really nothing we can do for a period of time until their lease is ready to be renewed. Then we can now add an addendum that this is part going forward. You start reimbursing us for the water and sewage. So these are conversations I normally would have if I see cases like this from just a report like this. So overall, if I scroll down, so I can see that my total, long and short, after I've taken cognizance of all the things under my income, my actual income was 213 and my budget was 215. Not far apart. That means we are right on track. But let's assume my budget was 215 and my income was 190,000 or 150,000. Then there's something. I need to understand why my budget is off track. So your budget sometimes acts like a KPI for you to know when you are off track. So budget is very important. So my income tells me I'm on track, I'm doing very well. I move on. My next is my operational expenses. So under operational expenses, like I told you, these ones occur every day. That's why it's called operational. It's like a daily occurrence, the things that will help your property perform well every day. You must do adverts to attract, to put your property on the map. General admin, there are some administrative things that that you need to take care of that will help the property function well. So the same way I did for my income, I'm also going to do that for my expenses. I'll be putting them, what's my budget for advertising? Like you can see under advertising, I budgeted $650 for it, and in reality I spent nothing. It meant that maybe my property was literally every time performing well. Maybe we're averaging 95% every time, and people were always driving by, and there was no need for me to spend on advertisement. Maybe that might be the case in this place, but you can see it's $0. Maybe it was words of mouth or referral, and I just did not need to spend any amount on that. So many things to determine what kind of advertisement you will do. I don't want to go into that, but really I'll go into that another day for you to know what kind of adverts suit your property. It's not one size fits all, guys. It's not. The next one is my general admin. I compared that. So if you go down, so these are the things under expenses, your advertisement, general admin, payroll, because you are paying some people, especially if they are large properties, you must have a team on ground. You have a payroll, you have utilities, you have repairs and maintenance, you have contract services, you have turnover, you have your management fee, you have your taxes and insurance. After that, you can now see, let's compare. What did my budget say? My budget said that my expenses should have been $69,811, but actually I spent $84,000. Now the question is, what went wrong? Is my budget not stating facts, or am I spending more than I should? That is the question I'm going to ask. So once I see this, I go back and start tracing which of these buckets or categories are the ones that went higher than normal. And that is how we drill it down till I now get my answers from the property manager, and maybe even create recommendations and prevent it from happening next time, or question the budget. Is it possible that the Ukraine war or the Russian whatever that's been happening has made utility go higher than normal, or has the utility company come up with a new rate and is affecting our utility, and that is the new norm? If that's the case, it means that my interpretation might be my actual might be performing at its capacity, then my budget needs to be reviewed. So this, it does both. It tells you, when you drill it down to find out why there is a discrepancy, it gives you two questions. Is my budget still doing what it's supposed to do? Has the market left way above what my budget is saying, or am I operating the property below what it should? That is it. Then the next thing I'm going to put my budget side by side with is the net operating income. So let's not forget, the net operating income is what you are after, not just what you are after. The net operating income is important for the value of your property, because you know you are going to exit from this property. This is very important for you. So it means your budget will have to really work hard here. You need to work hard with your budget to ensure that your net operating income aligns with your budget or outperforms your budget. Because if this is lower than what your budget says, you will not meet your goal. The tendencies that you will not meet your target or the amount or whatever it is you promised your investors, that, oh, we're going to give you a 2x multiple, or it's going to be a 20% IRR. This is where it starts. It starts from your net operating income, the value of your property. So this is a very important thing. So once you've noticed this, let's say in January, you go back to the problem, you drill it down, then you question it and find out what actually is the problem. And from there, you'll be able to say, okay, I think we need to improve on this part of our budget. So for us, when I noticed that our electrical was going high, immediately I said, guys, let the tenants start paying the electricity. That was the way I was able to combat the increase that came out from the electrical company. That was how I was able to do it. Another way is you might try to introduce solar panel. If solar panel is going to help you reduce your cost, by all means do that. But you have to compare, what am I doing today and what will solar panel do for me tomorrow? You compare both and decide, that might be the solution for me to get my actual to be on budget. Or I can decide that I'll do ROPS, that is, I'll pay for it, the tenants will give me back a percentage, refund me back, and in that way I'm saving money. So when you do all this type of things, it will make you drill down to the real problem and how to address it, and you start coming up with solutions and all that. But if you don't track it, like I said last week, how do you know you have one? So your net operating income in this instance, what your budget will help you do is for you to get your property on track and the value of it to improve. So the higher your net operating income, the more your property is going up in value. So that is for value. If you want your property to go up in value, watch out for your operating income. The next one, another thing that people don't really concentrate on is the CapEx. CapEx. We call it under the line items. And the reason why we call it under the line, anything below the net operating income are considered under the line items. And what are they? They are the CapEx, the mortgage that you pay to your lender, your asset management fee, whatever it is that you do that are not operational expenses or income are considered under the line items. Now, some people don't monitor the under the line items, and that can become very deadly. Why you need to monitor your under the line items and why must it align in your budgeting is because if you don't, it's likely that your investors will not get a dime. It's possible that you're making a lot of money. You're saving a lot of money in your net operating income. So if my net operating income says I have a balance, after I've paid all my expenses, I have 128,000, that means I have quite a bit. Okay, what is the other priority I need to take care of? Because the 128,000 is not for me to spend. I still have mortgage to service. My mortgage interest payment is 57,000. The principal payment for it is about 8,649. So the combination of this and the mortgage is about 60 something thousand dollars. So out of the 128,000 I got for my net operating income, it means that 60 something thousand is going to be used to pay for my mortgage. If I deduct that, it means that I will have something like 60,000 left. So that 60,000 can be used to pay your investors, or for you, if you don't have any investors, for you to take home and enjoy yourself, or it can be used to do your CapEx and you take some home. So that 60,000 now is based on how you are able to control the CapEx. So for example, if you outdo yourself, you are not following your budget and you go and overspend that 60,000 or whatever amount that is left to do CapEx, your investors will suffer for it. So from the beginning to the end of your deal, you need to track it. It's possible that your net operating income is very good, is high, but you are not seeing a dime. Your property is bleeding. I mean, bleeding in the sense that your investors are not taking home a dime. Not because the property is not doing well, but because you were not tracking your under the line items. So going by that, if that's the case, that means under the line items need to be put under budget. That is, we cannot afford not to have them align with our budget. If not, it's going to impact our investors. And remember, the idea is that if you're able to make your investors happy, they will likely become a repeat investor. But when they are not happy, that's it. That deal might be the last time you have it. And you know how difficult it is for you to get one investor. It's very difficult. So you want to keep your investors. And this is the way you can keep them. So you have to keep your CapEx in track by tracking it with your budget. So now my budget says that my CapEx should be 21,902. In reality, I only spent 11,000. Fantastic. So in the long and short, after taking out my 11,812 for my CapEx and also paid the lender 60 something thousand, I had $39,000 for that month to give to my investor. This is how you align your OpEx, operational expenses, your income, your CapEx with your budget. That's how you align it. Your NOI should address the value of the property. Because you want to sell, you must ensure that your NOI handles that. Then for your under the line items, they address your investors' expectations. If you want to meet your investors' expectations, this is something you need to take care of, because you might be overdoing things and investors are suffering for it, despite the fact that your property is doing well on the other side. So I'm going to wrap up by saying that some of the tips for you to create a smart budget. Number one is for you to separate your CapEx from your OpEx. Like I helped you to identify, there are two different things. You have to separate them. They are not the same thing. Don't put them, because if you add your CapEx to your OpEx, it's going to affect your net operating income, and that's not what you want. You need to categorize them properly. The next one is for you to create a CapEx reserve. So a CapEx reserve will help you fund your CapEx. So some people fund their CapEx from their income. That is what the tenant is paying. Once they pay their operating expenses, the remaining one, they start using it to do some repairs. No, the best and the right way to do it is that at the beginning of when you are buying a property, while you are raising for your closing fee and your down payment from your investors, you need to also raise for CapEx reserve, so that the money you're collecting from your tenants will not be impacted because you are collecting funds from your income. Rather, you're taking it from your reserves and you're using that to fund your CapEx. If you do it that way, that will help you save a lot of money for your investors, and your investors will go home happy. Most times is how you're able to manage your below the line items that will determine if you have repeat investors. So you need to look into that. Then track and review your OpEx. Don't always settle for what your expenses look like. Every time I'm always going through my expenses to look at where are the wiggle rooms, where can I control my expenses? Okay, can I reduce on my advert? What does my advert look like? What type of advertisement should I be given? My utility, should I start charging my tenants for it? Or if I have individual meter, maybe it's how time the tenants start paying their electrical and I don't have to be responsible for that. Or do I need to change my lightings to LED to reduce the consumption? Those are conversations you have to improve on your OpEx. Do I need to start litigating my taxes? What do I need to do? Because it feels like I am overly assessed by the county. I need to litigate it and bring it down a little. We recently saved about 90,000 on one of our property on litigating our taxes. Another one we saved 47,000 or so for litigating our taxes. So these are ways you can address or review or track if your OpEx is on track. Then balance cash flow and distribution. Yes, you want to make your property the prettiest in town. Don't do it at the expense of your investors. And at the same time, it's like two-edged sword. One of the edges, you need to put your property in to be in the right, in the nicest way. Maintenance is very important. The other edged sword is you have your investors to cater for. With the right budget, you'll be able to balance things. That is, your property will not suffer because you want to give your investors a distribution. And at the same time, your investors will not suffer because you want to do CapEx. So that's what your budget will help you do. And the last but not the least is think return on investment, not just expense. Everything you do must align with your return on investment. What returns is this going to give me? That's what you should do. There's a question here. It says, how do you litigate taxes? We have attorneys that are litigation experts. All you need to do is reach out to them. They will ask you to provide some documents and they will file and they do the entire process for you. But there are some documentations you need to do. And if they're not able to do it the normal way, the first stages, they might go now to court to sue the city for over-assessing the property. And if they are right and they have all their comps, and because all these things have to do with comps and what your property is making and the current value of your property, all those things will be assessed for them to determine, okay, I think you guys are right, but you need an attorney for you to litigate your taxes. You can't do it by yourself, except you're an expert in that field. If you are, fine. But there are many attorneys that handle cases like that. Is there any question out there? Any comment? If you want to talk, we can bring you. Before I go out, I want to share this with you. For those of you that are always coming here to listen, we need you to go right to subscribe to our YouTube channel. It will do us well to spread the word out. I just want us to know that these things I'm doing, they are free. I have some staffs that work for me at the back end and I pay them. So, and for us to do this, it takes a lot of motivation. I've not seen return on investment on all these things I'm doing, really. So, but that's not the case. I'm doing it because I want to give back to the community, because when I started, one person gave me the opportunity and that's why I'm here. So why don't I put it back to people and all that? So one of the ways you help us to continuously be motivated in doing this is by you subscribing, and not just subscribing, commenting, liking, and this will help us go a long way in allowing so many people hear about this and how they can run or do their properties right. So please, you can scan the QR code on the screen and it will take you to our YouTube page and you can subscribe. And not just subscribe, watch the videos, because all the things I'm saying, I've said them in 1,000 ways on my YouTube channel. So if you go through those videos, you see them, but in a different form. Is there any question from anyone? Do you want to come on stage? I'm going to give us the next 1 minute. If there is no question, I want to assume that this was clear and everybody understood it. And I'm very happy. We had about 17 people come, but now I can see only 12. Anyways, I really appreciate every one of you that are here, and I hope this was very impactful, and I hope you will put this into practice. And besides, it's a knowledge that cannot leave you. Thank you, John. Thank you so much. You just need to continue. This is the type of education that I received. I also do asset management calls on another platform, and on that call, I told people that I literally did not spend a lot of money getting education. Most of it was through subscribed YouTube channels, the ones that I trusted. I learned a lot from there. So this is one of the ways you can easily learn. I'm not saying that you should not join communities. I later on joined, but was for a different purpose. I wanted to be in the midst of people like me with similar goal. That's what I did, but I didn't pay the same amount like a novice would, someone that is new in it. Some people are paying as high as 30,000, 50,000. I would never pay that kind of amount for something that I have massive knowledge about. lot, but I can pay a smaller amount to be in that community, to have access to people like you. So that's the difference. So for example, someone else came pay 30, I came in, I paid 4,000. That's the difference. So learn all you can learn so that when it's time for you to go into those communities, you don't pay as much because you have a lot of knowledge. Time is our biggest asset. Yes, it is. Would you say? Yes, I would say that time, because multifamily, it's all about timing. Sometimes timing can just help things become better, but it does not mean that if your acquisition process for a deal is bad, a deal will automatically become good over time. No, there's a difference between kicking the can down the road or just waiting it out because maybe things are likely to go better. That is, inflation might go high. If inflation goes high, that means your rent will go up and that will increase the value of your property. Things like that, time can apply. Yes, so time is one of our biggest assets, everyone. Garen said, thank you, Bibi, for paying it forward. This call was extensively valuable. Yes, I hope you start implementing it as well in everything that you do. So since there's no further question, I guess it was as easy and very clear as possible. I would say bye-bye, and I'll see you in the next 2 weeks. Thank you all and have a wonderful day. Thank you, Desiree. Thank you for your time and giving back. I look forward to learning more from you. This is my first time on your call. Fantastic. Desiree, go to our YouTube channel and subscribe. Definitely expect an email from us. Everyone that attended, you get an email on how you can constantly be on track with where our trainings is going to be. Any event or wherever I'm speaking, you get an email from us to notify you that something will be coming up. If you are available, you can join. So thank you all and have a wonderful time. Bye-bye.